We interrupt this program to bring you a special report.
The area that I feel reasonably comfortable in is I'm short the United States dollar. Currency trends tend to run at least 2 or 3 years. We had a long one here, over 10 trillion, something like 13 trillion came into the US dollar.
I've been reading The Fool's Pilgrimage. I am the fool. And the true mysteries of life have always been regarded as paradoxes by the wise. Thus much that appears foolishness is in reality but misunderstood wisdom. We can readily change ourselves from blind fools into wise fools, provided we know how. Tune in, folks. He said 2-year trends. And I'm going to say this word paradox. The paradox is that with the initiation of quantitative easing by the Federal Reserve in America in 2009, the dollar has been trending higher versus the world's other currencies. So 2009, 2023, that is 14-year trend. Was that trend broken last year? Perhaps. But I kind of want to say I feel that trend is still in play. Anyway, all these interruptions. Back to Stan.
During the previous decade, I will say, full disclosure, I missed the dollar, probably the biggest miss of my career in currency trade. I missed the last 9 months run up in the dollar. I just couldn't bring myself to own Joe Biden and Jerome Powell. But I think now that on a relative basis, the tightening in the U.S. going forward will not be as much as the foreigners now that we've weaponized the dollar, and you've got people like Lula running around asking why we need to be trading in U.S. dollars. By the way,
I mean, come on, Stan. I mean, first of all, there is no role for prejudice like Biden and Powell within investment deliberations. And then, so on the one hand, you dismiss the dollar in terms of those personalities, only to kind of accept the dark side, and you start citing very implausible kind of friends like Lulu. And actually, I would say that the greatest bull markets, I say this all the time, the greatest bull markets arise when those who know it best, Stan, love it least. Let's continue.
It's not a bad question. Historically, we could be trusted. We had a rule of law, a lot of things. So about the only space I have any risk on right now is in the U.S. dollar. Don't want out in short dollars. I could change my mind in a week. But that's where I am right now, and I'm also long gold, obviously, for the same reasons.
Oh, gold, you're making me old. Stan's a genius. Stan's allowed to break his own rules. But as much as Stan's short surprises and is a cause of great discomfort for me, I don't really have a trading perspective on the dollar. I wouldn't exhaust precious risk capital building up a dollar position. Currencies, what is the value of a currency? Is it the relative cost of a McDonald's burger? Kind of, maybe, it's very tenuous. And whilst I think where we are with the dollar, I can kind of perceive, but this is like a Rorschach test. It kind of exposes the inner demons, the inner prejudice. And I kind of think that I actually think the dollar looks ready to rally here. But would I actually commit precious risk capital to trading currency? I wouldn't. My preference for my biggest risk position, unlike Stan, is in the treasuries, where you've had mean reversion. It has fallen, it's capitulated, it's collapsed. And more than that, I'm going to bring up a chart again. I'm going to show you the monthly bar charts for the S&P leading up to what we now know with the benefit of hindsight was the low in March 2009. And what I want to demonstrate is 1, 2, 3, 4, 5, 6, 7, you get the picture, months where the market oscillates and forms a bottom. It's interesting. It's interesting, the world of macro. I wouldn't pursue this analysis with stocks. There's too much eclectic, eccentric, idiosyncratic risk for individual, like commodities or stocks or corporate bonds. But we're talking about the 4 cardinal points of the macro compass. It's quite powerful. And let's look again at the 1, 2, 3, 4, 5, 6, 7 months where, despite the rage and despite the pontifications by everyone about this inflation disaster which is befalling us, that long end of the treasury market seems to be stable. And that's usually a precursor for upwards action. Anyway, upwards and onwards with Stan the Man.
Just to come back to this, so you say you haven't seen it as problematic for 45 years and it's really complicated and so on. So what do you do then? You just sit in cash or?
Oh, sorry, Stan, but if I was answering this question, this is the global economy is $100 trillion, the GDP. Financial assets are 4 or 5x, I think 5x that. That's $500 trillion. The money makers, the guy on the left-hand side, the manager of the Norwegian sovereign wealth fund. This is typical. It's like, you got to keep the punters at the roulette table. You got to keep them in the casino because $500 trillion, you just need people trading. They need people trading. You don't always have to trade. There are times when the best way to double your dollars is to fold them in half and put them in your pocket. Let's see what Stan says.
Oh, no, I'm too. I'd like to say I sit in cash, but I'm too much of a junkie. I'm always doing something. I'd say our equities were about 3% net short, which is nothing. But again, there's always equities we like versus other equities. Our fixed income position is minimal, except in JGBs, where I don't know whether I'm going to get paid or not, but I think the risk reward is ridiculous. It reminds me just a little of the 2 years ago. They have an inflation problem, but again, I'm dealing on government action. So it's not cash. We got stuff going on, but I'd say my P&L doesn't move generally more than 30 or 40 basis points a day. That's how buttoned down I have what I'll call our matrix here. Our matrix being the button bar of
30 basis points, I suspect. He's running a portfolio bar of about 8 to 10. But even then, when you get explosive moments, that's kind of like, that could be a 1.5% or 2% up or down day. But that's kind of the risk profile that I attempt to run most of the time.
I'll be back.